In this report, I'm going to show you how to easily identify the trend in the Australian dollar, how to capture the interest rate differential between the U.S. bank borrowing rate of 0.12% and Australian dollar deposit rates, for example on the 2-year, currently yielding 2.12%. In the first example, we're using no leverage. In A, you'll see a value of 1. B, 2.1107%. Again, this is using no leverage. In this example, I'm borrowing US dollars at the bank borrowing rate of approximately 0.12% and depositing in Australian dollars at greater than 2.12%. In A, I'm using a leverage of 5 to 1, creating a net return of 10.5534%. In this example, I'm using a leverage of 10 to 1, shown in A, to generate a return of 21.1069%, shown in B. The way these trades are structured, risk is defined on the trade-in for the duration of every trading period. Directly below this video in link 1, it'll say click here for the June 2015 Carry Collar Risk Reward spreadsheet. Please open it. In order to use the spreadsheet, you have to enable editing. You'll find this at the top. Please click on Enable Editing, and this will let you put in entries for the spreadsheet to determine any potential outcome for these trades. In this example, our start balance is $81,490, shown in cell D4. We're using no leverage, shown in cell D5. Our margin requirement will show in cell D10, $1,800. Excess margin, mark to market, will show in cell D11, in this case $80,330. Our long entry price shows in cell D8, in this case 0.8149. Against our 81.49 long, we've written a out-of-the-money call at 82.50 in H7. We've collected $1,750 in premium in K7. The only way our position can be called away from us is at a profit at 82.50 in H7. Remember, we're long at 81.49. Using that collected premium in K7 of $1,750, we've purchased an 80 put in N12 and paid out $1,720. This way, if the market stays the same, we've got a net credit in time value of $30. If the market continues its uptrend, the position will be called away at a profit at 82.50 in H7. If the Australian dollar goes to zero, we're protected against any losses by our put that we purchased in N12 at 80. Let's experiment with some of the potential outcomes for this trade. Our start balance of $81,490 shows in cell D4. Let's assume the Australian dollar goes to zero against the US dollar. In cell D3, enter 0. Again, cell D3, 0. The net loss on our $81,490 start balance will show in F4, $1,590. The liquidation value shows in F3, $79,900 after all fees, commissions, hedges, everything in. Even if the Australian dollar did go to zero, we've got plenty of time. Our initial position was established 1/16/2015, cell F10. Our expiration is 6/5/2015, shown in cell F11. Days to expiration 141, shown in cell F12. The one thing I like about collars is, in this case, we collected more time premium than we paid out. We collected $1,750 on the call that we wrote, and we used that premium to purchase the put. So we're protected. Our risk is defined for 141 days, and we got paid $30 to do it. Let's assume the trend continues, we capture the carry, and our position's called away at the call option that we wrote at 0.8250. In cell D3, enter 0.8250. The net profit after all fees, time values, bid-ask spreads, everything will show in cell F4 of $910. Liquidation value in F3, $82,400. Again, I'd like to remind you we're using zero leverage in this example. How we set these trades up is pretty simple. The first thing we're going to do is qualify the trend. In cell D2, click on the June 2015 delivery chart. When the chart opens up, click on Indicators. Let's keep this simple. When indicators open, click on Bollinger Bands. The first thing I'm going to do is look at the center line, if it's pointing up or down. Technically, this looks like a bottom to me. We've got the middle line turning up. We've got 3 violations of the upper band. Fundamentally, I like the Aussie. It's a commodity-based currency backed by tangible assets. It's got a higher debt rating than the United States, higher interest rates than the United States, and as I see it, better fundamentals across the board. The next thing I'm going to do is check my cash quotes. Using the spreadsheet, cell B6, click on Cash Quotes. Bloomberg cash quotes will come up. In this case, we're looking at 0.8220. Again, 0.8220. Next, I'm going to check my futures quotes using the spreadsheet cell B7. Please click on cell B7. When the futures quote page comes up, I'd like to draw your attention to the June 2015 delivery. In the example here, we're seeing it at 81.45, which is at a 158-point premium to the June 2016 delivery, trading at 79.87. The only reason for this 158-point discrepancy is to reflect the interest rate differential between the US and the Australian dollar. If you calculate it, the June contract is trading at a 1.9782 premium to the June 2016. As we move closer to delivery, for example, the June 2015, it'll come up in price to mirror the spot market. At the time of this report, the spot market was trading at 82.20. For quotes, see B6. At the same time, the spot market was at 82.20. The June 2015 forward for the Australian dollar was trading at 81.45. The only reason for this 75-point discount, again, was the interest rate differential between the US and Australian dollar. For futures quotes, see link B7. Finally, let's have some fun and leverage this position up. Using the spreadsheet in cell D4, enter $10,000. Again, D4, $10,000. In cell D5, enter 2 positions. Again, D5, 2 positions. We're using the same entry in cell D8 at 81.49. We're using the same caller to hedge our position. We've written the 82.50 call against our 81.49 long, shown in H7. For each position, we've collected $1,750 in time premium, shown in cell K7. Using that time premium collected, we purchased a put at 80, shown in cell N12. The cost of the put, shown in P12, was $1,720. What we've accomplished, the only way our position can be called away from us is at a profit. We're long at 81.49. We've written the call at 82.50. If the market goes to 0, we don't care. We own the put at 80. We're protected for any and all losses from 80 to 0. Our net cost was a credit of $30. In other words, we got paid to define our risk, not only on the trade, but for the duration of the trading period. Now let's review the potential outcomes for this trade. Let's assume the Australian dollar goes to 0. Enter 0 in cell D3. The net loss will show in cell F4 of $3,180. This includes all bid-ask spreads, all option premiums, all commissions, regulatory and exchange fees. The net liquidation value on the $10,000 deposit will show in F3 $6,820. Let's assume there is no carry, and the market stays exactly the same at 81.49 for the entire duration of the trade, from January 16, 2015 to June 5, 2015, or 141 days. Enter 81.49 and sell D3. Again, 81.49 and sell D3. The same as the entry price. The net loss will show in cell F4 of $200. This includes time value, all bid-ask spreads, all brokerage, clearing, exchange, and regulatory fees. The net liquidation value will show in cell F3 of $9,800. Next, let's assume the Australian dollar does nothing but pay the carry charges, which is the interest rate differential between the US and Australian dollars. Enter 0.8222 and sell D3. The net profit, after all bid-ask spreads and fees, will show in cell F4 of $1,260. The liquidation value on the trade will show in F3 $11,260. Let's assume the Aussie establishes an uptrend, and we move from the current 81.49 basis the June 2015 delivery up to 83. Enter 0.8300 and sell D3. The net profit will show in cell F4 of $1,820. The net liquidation value in F3 of $11,820. Keep in mind, this program is designed to capture the interest rate differential, not knock it out of the park on some trade like the Swiss franc recently. We're going into each trade with the expectation of catching the carry, using a defined risk strategy not only on every trade, but for the duration of every trading period, without wasting precious investment capital on time premium to hedge our positions. If you have any questions or need additional information, or would like me to walk you through this or any of the other strategies we trade, please contact me. For additional online information, click on Review Links in cell F2. The links in F2 will provide information on the world's largest dollar volume exchange group, clearing and exchange members, how your funds are guaranteed plus or minus trading activity, an in-depth look at the financial safeguard system protecting your funds, the markets we trade on the Chicago Mercantile Exchange, Eurex, Euronext, the Commodity Futures Trading Commission, which oversees futures trading, my career history, and how to open an account. There are an additional 100 links for additional strategies and markets. My favorite for 2015 through 2017 is trading short-term rates higher on link 17. Thank you for watching this video. If you have any questions or need additional information, please contact us.